Hello, everyone, and welcome to another edition of our More Than Markets series. My name is John Bay, Senior Vice President and Chief Investment Officer of NEI Investments and Avisa Wealth. What I want to address today is the changing nature of the bear market and what that means for a potential bottom for the stock market. As listeners well know, we are dealing with four strong headwinds to the markets for the first 4 months of this year. Those headwinds are high and persistent inflation, two, a very aggressive central bank as they try and bring inflation down into their targeted range of 1 to 3%. Three, a Russian invasion of Ukraine, and number four, lockdowns in China as that country deals with with COVID and the latest outbreak in that country. And so, as I mentioned, the first 4 years have been a very difficult and unusual time period for investors. What I mean by that is typically when you have markets that are down significantly as they are, you typically see the bond markets rallying as investors leave riskier assets such as stocks and they go into the safe haven such as bonds. But the first 4 months have been very difficult for stocks and bonds because of the nature that this bear market has been driven primarily by rising interest rates from the central banks. And as a result of that, we've seen very sharp drawdowns in both stocks and bond markets. And so, I think something really interesting happened last Monday, May the 9th. And it's something that most investors may not have noticed because it happened in the pre-market of Monday morning, where the 10-year US Treasury yields hit 3.2%. Now, that's not unusual in and of itself, but what was notable was what happened afterwards, because after the Treasury yield hit 3.2%, it really bounced off that level and began to fall for the next 4 days. And so when yields are falling, that means bond prices are up. So then over the next four days, even as equity prices fell, bond yields started to rally, which again was very unusual from the first 4 months of this year. And so what does that mean? Why is that important? And what does that potentially signal for what's ahead for investors? I think from my perspective, this signals that we have moved to the next phase in this bear market, where the first 4 months were characterized by inflation shocks and interest rate shocks driven by the central bank. But with this new development, we're going into a growth rate shock. And so there's no question that as a result of higher interest rates and some of the shocks that we're seeing around the world, that estimates for economic growth rates around the world are beginning to fall, both domestically here in North America, Canada, and the United States, as well as in Europe as they deal with very high energy prices, both on natural gas and oil prices. As well as globally with China, which has been one of the major growth engines of the global economy over the last 10, 20, even 30 years, as they are dealing with the lockdowns and the hit that, as well as real estate, to that economy. And so with traditionally, when you see a growth scare, you see that traditional relationship between stocks and bonds begin to kick in, that as investors begin to flee the riskier assets of equities, they go into the safer havens, such as the bond market. And that's exactly what you begin to see this week. And so up to this point, we've seen a very strong positive correlation between stocks and bonds, which is when stocks go down, bonds go down. When bonds go up, stocks go up. And what we are seeing now is a change in that relationship, that as stocks go down, bonds go up, and vice versa. And so, again, I think that this is driven by this growth scare as investors become increasingly concerned about weak economic growth. But I think it's really important for us to note that again, we're not concerned about weakening economic growth. In fact, actually, we welcome it. And the reason why I say that is because again, one of the key drivers of the inflationary pressures that we're seeing across the world is because of very strong demand for economic demand, and that demand is outstripping the world's ability to supply. And again, these supply chain dislocations are well known by listeners on this call. The lingering effects of COVID, as well as the dislocation caused by Ukraine, the war in Ukraine, and the impacts they had on energy and other raw materials and commodities, as well as again, the lockdowns in COVID again continue to complicate the supply chain. And so the only reason, the only way that we can get back to, again, normalizing some of the inflation that we see is to dampen demand by higher interest rates, slow down the economy, get supply and demand back more into order, and that will allow inflation, hopefully, to get down into that targeted 1% to 3% range. And so really, where do we stand today? Well, stocks have fallen down into well, I want to say extreme levels, but what really has fallen into extreme levels is sentiment. If you look at some of the bull-bear sentiments that have decades of track records, the fear and greed indicator that we see out there, they're at March 2020 lows. Also, when you look at corporate bond spreads, they're at cycle highs. Another fear index, the VIX index, is at cycle highs, and so all of this points to a short-term bottom in the stock market. And that, and there's also many positives that we can point to. For instance, we've just come out of a very strong first quarter earnings season where despite the fact that we have very strong inflationary pressures both on wage as well as the cost of inventory, corporate earnings estimates for the year have actually gone up, not down. Valuation earnings have gone up and stock prices have gone down. Valuations have corrected into more normal levels. The S&P 500, for instance, have on a forward basis spent most of last year at 23 to 25 times forward earnings. We're now down at 16 to 17 times forward earnings. And so again, when you start thinking about, okay, where should a normal PE ratio on the S&P 500, an old rule of thumb has been 20 minus the rate of inflation should be the PE ratio. And if you think that inflation will normalize a year from now in that 3 to 4% range, 20 minus 3 to 4 points to a PE ratio of 16, 17, which is, again, exactly where we are today. So we are seeing signs that hopeful of a short-term rally here, and that short-term rally may take us up to the top end of the trading range. And that actually might happen very quickly, given the volatility that we're seeing in the markets today. Is this an ultimate bear market low? We actually don't know. Big determinant of whether this will mark the low for this whole cycle will determine whether or not we go into a recession. And again, it's just too early to say. We, like the central banks, will be monitoring the data very, very carefully. Again, a recession is not our base case scenario. We think that the economy is still strong. We're seeing very strong employment growth with 2 jobs available for every unemployed individual. We're also seeing very strong balance sheets, both at the corporate and the personal level. And again, interest rates, despite the fact that they're rising, are still not at neutral rate. And so we need to monitor how the economy will react to increased interest rates as the year goes on. So, with all of that said, we do think that we are closer to the bottom than the top. And again, we would certainly encourage investors here to stay disciplined and stay patient. The good news here is that with correlations returning into negative between stocks and bonds, what this means is that that's really good for diversified portfolios, such as balanced portfolios, and that dampening effect of stocks and bonds again will lead to smoother returns for investors in those balanced products. So again, we're encouraged with where we are, and we do encourage investors to stay patient and to stay disciplined in these very volatile markets. That's it for me. Thank you so much for tuning in. We hope you found that today's discussion helpful. Please watch out for next week's edition of our More Than Market series. And as always, please reach out to your NEI representative with any questions that you may have. Thank you very much, everyone, and please stay safe.